Hi everybody, and today we're talking about JEPQ, or the JP Morgan Nasdaq Equity Premium Income ETF. This is going to be a new ETF that just came out about 4 or 5 months ago, I believe it was. In fact, we can look at the track record, and it looks like it came out on May 6th was when this fund was released. So that shows the first day of trading, at least on Google here. So pretty recent for this ETF, and it really doesn't have a long track record. Now, there's a sister ETF that is JEPI. This one has been around for a bit longer. As you can see, that one was launched on May 22nd, 2020. And I have made a couple other videos on JEPI, or Jepq. And I do have those videos in the description below if you want to check those out. And for this video, I did make a presentation. And we're also going to go over this right here. I kind of made a spreadsheet as well. But this presentation is based upon the fact sheet on the website, so you can go, and I'll leave that link below as well, but I kind of put it into my own words. With that being said, let's get started, and let's go over this ETF and what this has to offer for investors. All right. Let's let this load here. Apologize, it's taking a little bit longer than usual. See if this thing will load anytime soon. There we go. All right, so the JP Morgan Nasdaq Equity Premium Income ETF. So what does this ETF do? Like, what's the goal of this ETF? Well, the first thing you have to understand is that this is going to be invested in U.S. large cap growth stocks that seek regular monthly income from the options premiums and the stock dividends. So you're looking to get a significant portion of the return of the Nasdaq index with lower volatility. Those are the stated objectives on the fund's website. I kind of put that into my own words, but essentially this fund will seek to get a significant portion of the return of the Nasdaq index with lower volatility. So they utilize a proprietary data science-driven investment approach, which is designed to drive portfolio allocations while maximizing risk-adjusted expected returns. So that's essentially, you're looking at lower volatility in simple terms, and also they're going to try to capture some of the upside when the Nasdaq's in a bull market, for example. They want to capture some of that upside. So what you'll see with a lot of covered call ETFs is that they're going to be selling call options at the money. And so what makes this ETF different is that they kind of follow a different strategy. So they're not going to be selling right at the money covered calls. So the strategy they're employing essentially allows them to capture some of the upside in the Nasdaq in a bull market. Now, what we've seen lately is that we've been in a bear market, and there really is not a lot of history on this ETF since it's new, but it'll be interesting to see how this performs. If the Nasdaq keeps going down, for example, let's say over the next 6 months or so, it'll be interesting to see how this performs and where this goes over the next 6 months. All right, moving on to the next slide here. So here's some additional information on the investment process. This comes straight from the website, but you'll see here the first thing, underlying equity portfolio and applied data science process utilizing 40 plus years of JP Morgan proprietary data to create a fundamental framework for security selection and portfolio construction. And then you'll see here at the bottom, income addition, right? So that's going to be the main goal, and that's the main consideration I think you should keep in mind. And we'll get into those in a little bit more detail here in just a minute. But essentially what you're looking at is seeking to provide income for income models through monthly dividends and options premiums, okay? So then you have the options overlay component, which is going to be a 1 month out of the money call option strategy designed to generate income and give investors a portion of the upside with reduced volatility. So just as I was describing. And then number 2 here, diversified equity solution for investors wanting more equity exposure with lower risk. And then third here, a well-represented, fundamentally driven NASDAQ 100 strategy that seeks to provide clients with monthly distributable income via options, premiums, and dividends. And then we have credit replacement, which is utilized for balancing income with prospects for capital appreciation. So kind of like I was just describing, they like to make it a little bit complex there and kind of use those fancy terms, but essentially you're looking at less volatility in a bear market, and then on the upside component, you're looking at capturing some of it in terms of the NASDAQ index, right? They want to capture some of that upside and give that regular income distribution on a monthly basis to their investors. So I think this is a very important question to ask, like, who is this ETF for? And you'll see that I have the golf there, right? Because when you're thinking of retirees, right, I think of like, golfing and living off your dividend income. That's obviously my goal, is to live off my dividend income. And I'm sure a lot of you guys watching this are probably interested in doing the same thing. And so when you're looking at an ETF and who this would be best suited for, you're looking at retirement investors who are looking for consistent high yield passive income against their portfolios. And so although the fund is new and significant dividend history remains to be seen, so far the ETF has delivered an average yield of 11.58%. And I'm going to get into that spreadsheet here in just a minute so we can go over exactly how much income you could make, like how much would it take to make $1,000 and vice versa. So assuming this remains the average over the long run, an investor who puts even $25,000 into JEPQ could realize $241.25 in dividends per month. Now that's based upon the average, and so that's taking the dividends over the last 4 months. And like I said, we'll get into that in just a minute, but it kind of gives you some perspective on how much you would need to invest. So for a $25,000 investment, you're looking at $241.25 in dividends every single month. All right, so fees and expenses. This ETF charges an expense ratio of 35 basis points. And this means for every $10,000 invested, you can assume that there'll be $35 in fees. This is just going to be deducted from the fund's annual return. A lot of times you'll just see it deducted from like the distributions, depending on how they take that out. But essentially, you won't even see this. Like it's not actually going to be a fee that comes out of your account. It'll be charged by the fund and just deducted from the annualized return. All right, so the next thing here, portfolio and holdings. So we have, as of 9/26, 83 holdings. You see the turnover ratio of 12.25%. And then the top 10 holdings here, you'll see that we have a lot of the companies that you would see like in the Nasdaq index, Apple, Microsoft, Google or Alphabet, Amazon, Tesla, Meta platforms. And so you're seeing the percent of assets over here, then the total market value based upon the assets under management. And so you can kind of look at that. Now, so some important considerations, and I think this is definitely something to consider if you're looking at buying this ETF for your portfolio. So ETFs, covered call ETFs that employ a similar strategy like JEPQ will generally have a track record of underperforming the major indexes in a bull market. And I know we've already talked about this, but let's get into a little bit more detail. So, specifically if you're looking at the Nasdaq for this ETF as the benchmark, when you're in a bull market, you're going to see this ETF underperform, plain and simple. And when you're in a bear market, you'll probably see this go down less than the Nasdaq itself. At least that's the way it's supposed to work, okay? So in bear markets, you'll see this second point here. The sold call options will generally provide the fund with less downside and lower volatility than simply owning the stocks outright. So underperform in bull markets, but less volatility, less downside than simply owning the stocks outright without any kind of call option strategy against it. So you should definitely consider your own investment objectives, whether you would like to sacrifice capital appreciation in exchange for higher yield income, because that is definitely an important consideration in my personal opinion. Like, are you looking for the maximum amount of growth? Well, then perhaps you would be better off just owning the QQQ, just owning the Nasdaq over the long run, dollar cost averaging, and getting that solid return. Or are you looking at passive income? Would you like to get a consistent monthly dividend? Are you in that stage of life maybe where you have built up a $500,000 portfolio or whatever amount you have? Maybe you're approaching retirement and you're looking at options for income. This could definitely fit into your portfolio if that's the case. You just have to keep in mind that when it comes to capital appreciation over the long run, it's not going to, like you're not going to get as much, essentially what we've been talking about already. But nonetheless, like you just have to ask yourself what your goals are. And another consideration is like, what if you were to take this ETF and kind of replicate it yourself, right? Instead of actually buying the ETF and paying the expense ratio and relying on fund managers, what if you were to do it yourself? Well, I've put together a lot of content already. I'm going to be working on more content, but there's right now about 20 videos that I'll be launching once we hit 1,000 subscribers. You can sign up for $4.99 a month. It's all about options passive income, and you can do that by signing up for the YouTube membership link. You'll see it there. You can support for $4.99 a month, and then you'll get access to all those videos. But the reason I bring that up is because perhaps you would be better served by doing this yourself, by selling cash secured puts, by selling covered calls, by doing the wheel strategy on individual stocks or even on a basket of stocks like the QQQ index or something similar. And so it all comes down to preferences. It all comes down to your goals and whether or not you want to manage your portfolio yourself. But for a lot of people, that can make a lot of sense, is doing it yourself. All right, so now we're going to get into the Excel spreadsheet that I created. Very basic. I just kind of want to go over this for fun here. So you'll see that we have the most four, or I guess these are actually all the dividends. So these are all 4 dividends that we've seen for this ETF since inception, since it just came out a few months ago. And what you'll see here is that you have an annual dividend yield, the most recent one of 15.15%. Now, the one before that, we had 11.29%. The one before that, 9.42%, and then 10.44%. And that's on an annualized basis, obviously. Like, you're not getting 10 to 15% every month. That would be insane. But so you're taking that on an annualized basis, and then the average annual yield based upon these 4 dividends so far is 11.58%. So we can simply take this number and we can multiply it by the amount invested and then divide it by 12 if you want to find the monthly dividend amount, or if you just want to find the annual income amount, you just take that number and multiply it by the annual average dividend yield there. And so you have $25,000 multiplied by that number. You'll see that we have $241.25, and then we have $2,895 in annual income. Now, if you're talking $50,000, you simply double it, $482.50, and then $5,790 in annual income. And then you have $75,000, then you're looking at $723.75 per month, or $8,685 in annual income per year. And obviously, these are just projections. I mean, this can change drastically. So even though we're sitting at an 11.58% yield right now, perhaps market conditions change and perhaps volatility goes down. There's less premium in the options that they're selling, and then you get less income. So perhaps this goes down to an average yield of 7% or 9%. So just something to consider. But going on down the list here, you have $100,000, $965 monthly dividend, and then annual income of $11,580 on that. $250,000 investment will get you $2,412.50 with the average annual yield right now. And that's on an annualized basis is $28,950 in passive income. And then you're looking at $500,000 if you were to put that much into this fund. You'll see $4,825 in monthly dividend right now. And then you'll see $57,900 in annual income. And then if you're looking at the amount invested on $1 million, you're talking almost $10,000 per month, specifically $9,650, and then $115,800 in total annual income. So pretty cool to think about if you're just looking to kind of have that autopilot monthly dividend. You're not really worried about the long-term capital appreciation and growth is the main thing. Like if you're not concerned about seeing your money go up or double or triple or anything like that, you just want to get that consistent cash flow. This can definitely be something to consider. But anyway, guys, hope you enjoyed this video. Let me know what you think in the comments down below. And until next time, I will see you guys in the next one. Take care.